Alex, active ETFs saw record introductions and flows and demand in 2025. What drove that, and what are your expectations for 2026?
Yeah, Greg. Well, first off, thanks for having me. It's a pleasure to be here. Yeah, last year, the industry saw 1.5 trillion flow into exchange-traded funds. About a third of that went into active ETFs. And this isn't a phenomenon that's been limited to 1 year. This has been an exponential story over the past 5+ years or so. I think what's driving it is explained through both supply and demand. Last year, we saw 1,000 new active ETFs brought to market here in the US, which is just astounding. On the demand side, investors, regardless of active and passive, have just voted with their feet and realized that ETFs are a better wrapper due to tax efficiency, lower costs, and some other structural advantages. But beyond that, investors are realizing that it's not just a one-size-fits-all approach for active versus passive. If you look at large cap US equities as an example, a much more efficient market. But in other markets that are less efficient and more complex, we feel active management can make the biggest difference. And that's where we specialize here at Cohen and Steers. Real assets, preferred securities, these are really inefficient markets where we think active can shine.
So Cohen and Steers, they launched their fair share of active ETFs in 2025. So what'd you launch and how'd they do?
Yeah, so we've been building our strategy around active ETFs for the better part of 3 years. We launched our first suite in February of 2025 across our capabilities in real assets and preferred securities. If we were to break this down, real assets that we define, we look at real estate, listed infrastructure, natural resources, and then on preferreds, we have core and short duration offerings. So CSRE for listed real estate, CSIO for infrastructure, CSNR for natural resources, and then on the preferred side, CSPF for core preferreds and CSSD for short duration.
And how are you helping advisors explain to their clients that they should get out of those mutual funds or passive ETFs and get into the active ones, which might cost more? Generally do.
Yeah, so the conversations we're having with advisors are really breaking down into two streams of thought. I think one is around the strategic case for these types of assets, right? Looking at the diversification benefits and how they can complement a typical 60-40 portfolio. But it's also around the opportunity we're seeing today and trying to highlight the case for active in these areas. And whether we talk about the core fundamentals of these type of assets and what's happening and transpiring in the markets today, we're seeing a lot of opportunities unfold for these types of securities.
Okay, so make the case. Why is today's market better for active managers than people who just want to own the S&P? I understand that the S&P 500, it's a bit imbalanced. It has a whole lot of those Mag 7 stocks, maybe a third of it or so. Why is this a good time to switch into active? Because those indexes have done pretty well over the last 3 years.
Yeah, let's use real assets as a broad example. So I think it paints a nice picture. Looking at whether it's real estate, listed infrastructure, or natural resources, these are essential assets to our real economy. These are typically income-producing assets that have inflation-linked cash flows. When you think about the characteristics of these types of companies, they tend to bring a lot of diversification to a portfolio. And if you look over the long term, they're also strong return assets as well. It's not just about the Mag 7 stocks anymore. We feel like the market is starting to broaden out, and these areas are starting to become a lot more relevant. If you think about the investment case today for these types of assets, we have a really interesting combination of low structural supply across many of these real assets, paired up with a lot of secular demand trends that are underlying these types of assets.
And then finally, what about on the fixed income side in terms of active management ETFs? Do you expect a lot more growth as well for bonds?
Yeah, it's interesting. The active fixed income ETF story has really been a shining star within the overall market. 1.6 trillion is what is in active ETFs today. About a third of that is in active fixed income ETFs. And you know what? They're growing at about twice the rate of passive fixed income ETFs, which is, I think, really interesting. I think generally speaking, investors have realized that active just makes more sense within fixed income. But beyond that, they're looking at the access you can get into active markets through ETFs, and looking at an area like preferred securities as an example. Passive preferred ETFs, they're typically limited to $25 retail securities. These are long duration assets that typically have a lot of interest rate sensitivity. As an active manager, we can access the broader landscape of global preferreds and open the aperture to things like $1,000 institutional preferreds, which generally speaking have a much better yield per unit of risk profile. We're seeing yields in the 6 to 8% range, and in a market where credit spreads are are well below long-term averages, we feel like the carry trade right now is really paramount within fixed income, and preferreds are a great way to access that. So,
All right. Well, thanks for coming on and talking about it.
Yeah, absolutely, Greg. Thank you so much for having me.